Hello, welcome back to Financial Management. So this lecture is going to go through a review of the time value of money. So let's jump right in. Okay, so our last lecture provided a general overview of the course. We really did a pretty thorough overview of the topics that we're going to cover as we discuss the role of the financial manager. This lecture, really our focus is going to be on making sure that we have a strong fundamental understanding of the concepts of finance. So future value, present value, finding the appropriate discount rate, calculating present value if you have an annuity or a perpetuity, and then also amortization, paying off a loan. So why do we care about all of this? Probably the easiest way to see how we've been applying discount is by looking at our present value equation. So there are a few things we want to point out. Again, on the left-hand side, we've got value, firm value. And on the right-hand side of the equation, we've got the discounted free cash flow of the firm. How are we discounting? You'll notice that every free cash flow has its own time subscript. So time 1, time 2, all the way through infinity. And then every weighted average cost of capital, it's being raised to that same time subscript. We always want our time periods to match. So if we've got a free cash flow that's 2 years away from now or 50 years away from now, we want to take our discount rate, our weighted average cost of capital, and appropriately raise it to the time period that's going to match. So we're always going to be discounting our cash flows. Now, that free cash flow, we're going to do quite a bit of work to understand and calculate. But for now, think of it again as all the money that's left over to be paid out to investors. So we've got our operating profits. We have to take out taxes. We have to subtract the fact that we have to make investments in our capital in order to generate those profits. Whatever is left over can be paid out to our shareholders and can be paid out to our creditors. That's the free cash flow of the firm. Before we get there, let's kind of build out a way to reorient ourselves when we think about these cash flows. So what do we have? We've got a timeline showing the timing of cash flows. Period 0, T0 is today. So here we are. We're here in time period 0. Now, in between time period 0 and period 1, this could be a year, this could be a quarter. Between today and tomorrow, T0 and T+1, there's going to be some interest rate, some discount rate, some way for us to discount those cash flows. You'll also notice how every single cash flow 0, 1, 2, and 3, are telling you when they arrive along the timeline. So we're going to follow that same convention, which you'll see in my examples, and what you'll see when we talk about this is we'll talk about the cash flows at different time periods. This can be sometimes a bit of a difficult concept to get your head around if you're not used to thinking in this time frame. But again, we're always discounting cash flows when we talk about corporate finance or any finance application in general. So let's do an example. Our first concept is the time value of money. Suppose your risk-free bank account pays you 5% per year. So today, if I put $100 in the bank, 1 year from now, if it's a risk-free bank account, it's going to have 105. What is that? The 100, the one that I put in, plus the 5%, the 0.05 multiplied by the 100 to get me my future value. Alternatively, if I told you that 1 year from now, I'm going to receive $105 and that the discount rate is 5%, if I told you I am certain, risk-free, I know for sure I'm going to get $105 a year from now, and that the risk-free rate was 5%, today, that would have a present value of $100. So what do we see? What we see is that there's a much more general application of moving between our future value and our present value. Notice how our future value at time t, subscript capital T, it's being matched to our present value today at time 0, multiplied by 1 plus our interest rate raised to that same T. So if we want to look at our future value for period 3, we would have our present value multiplied by 1 plus R compounded 3 times. We wanted to look at our future value for time 8, same thought. Present value multiplied by 1 plus R raised to the power of 8. Alternatively, if you were to receive future value T dollars at time T, today it would be worth present value of whatever that future value is, discounted by 1 plus R. Again, always making sure that our periods match. Okay, so let's do some numerical examples. Suppose the interest rate were 10%. After 1 year, we would have a future value of 110. After 2 years, we would have a future value of 121. After 3 years, we would have a future value of 133.1, so on and so forth. So it just keeps going and going and going. There are 2 things that I want to hopefully make sure that we can appreciate. The first is notice how our future value at period 2 isn't 120, it's 121. Why? Because our interest is compounded. So that's beautiful. That's the power of finance. It'll compound. Second, you can see that every single time we're raising the multiplier, our 1 plus our interest rate, to that same period. So we always want our time periods to match. If we generalize the approach from the previous slide, we can see there's a more general formula at play. We've got our future value for T equal to the present value multiplied by 1 plus I to the power of T. And it's that same concept over and over. Okay, so let's do an example. What's the present value of $100 due in 3 years if the interest rate, the yearly interest rate, is 10%? So what do we have? We know our future value. So 3 years from now, we're here at time period 0. At the end of the 3rd year, we would like to have $100. We also know our discount rate. We know our rate of interest, our discount rate. That's 10%. So what are we going to do? We're going to take that 100 and we're going to discount it all the way back to figure out what's it worth today. So an important point that we can't emphasize enough is notice how this is period 0. We start here at 0. And so the first year it's 10%, right? As we get all the way up, it'll always kind of be 10% for each year. So let's do that. When we plug the numbers in, what do we have? The present value of 100 multiplied by what? By 1 over 1.1, that's 1 plus 10%. This entire thing raised to the power of 3. So we always want to remember our order of operations. We always want to do our parentheses and then our exponents, and then we got our friends, multiplication, division, and finally addition and subtraction. So the reason why I'm emphasizing it this way is because sometimes, again, if we're not used to working in present value and future value, we can just want to plug it as we see it and get wrong answers. So what's the present value of $100 paid at the end of 3 years with a discount rate of 10%? Today, it is worth $75.13. You solved for it. Okay, how long will it take you to double your money? So in this example, what do we know? We know that today I'm going to spend $1, and we know that at the end of some period, we're not sure when, I would like it doubled. So my future value, I want to be twice as big as my present value. And what I'm trying to figure out is how to solve for my end. So let's set it up. On my left-hand side, I've got $2. On my right-hand side, I've got $1. And I've got 1 plus my interest rate was given. So my interest rate was 20%. And I'm trying to figure out how long is it going to take, given this interest rate of 20%, for my money to double. So as we have to remember our order of operations. very first thing we do, knock out those parentheses. We bring it over to the left-hand side. We bring our 2 over, our dollar signs will cancel out. We've got 1.2 raised to the power of 10 equal 2. Now, the thing that we're interested in is n. We're trying to solve for the time periods, how long it's going to take for us to double our money. So in order to get our n from being in our exponent to something that we can actually solve for, we're going to take the natural log of both sides. So in taking the natural log of both sides, our n comes down, and what do we have? We have n, the number of time periods, equals to the natural log of 2 divided by the natural log of 1.2. The natural log of 2 and the natural log of 1.2 are just numbers, and that's exactly what we see. We see that when we solve it out, we have n equal to 3.8. So n equal to just a little bit shy of 4. Okay, so the time value of money concept that we've been applying, these are if we have specific cash flows that are at some period in the future. What if we have a cash flow that's going to be the same? So let's talk about an annuity. We have a constant stream of C dollars paid for T years starting next year. This is called an annuity. We also have a perpetuity, which is going to be a constant stream of C dollars paid at the end of each year forever starting next year. So the formula for the annuity, there are 2 things I want to emphasize. First, starting next year. Remember, we're always here at time 0 looking into the future. So when we look into the future, we're looking 1 year ahead. So this is calculating today at time 0, the present value of a stream of cash flows for the next 5 years, 20 years, 30 years that have the same value, the same discount rate, but they start next year or next period. That's an annuity. A perpetuity is going to be perpetual. It's going to go on forever and ever. So these formulas, C divided by R multiplied by 1 minus 1 over 1 plus R to the power of T, and C divided by R, you're going to see over and over. It's less important to me whether or not you have these formulas committed to memory, and more important that you understand what they are, how to use them, and how to apply them. So let's go through some different examples. Okay, let's look at a simple annuity that's going to pay $100 for 3 years. We've got some interest rate, some discount rate I, and we know that it's going to pay $100 for year 1, year 2, and year 3. How could we solve for this? Well, we could draw out our timeline. We could discount each of those cash flows. Then we can sum them up. Or we can apply our annuity formula since everything is going to be the same. Since our discount rate is fixed, since the C, the cash flow is fixed, and since we also know the total number of time periods. Let's look at both approaches. So if we take our $100 and we discount it at 10%, we're going to get $100 every year for 3 years starting next year. It's so important to emphasize starting next year because it means we got to make sure to discount our first one. Okay, so we do that. What do we find? We find that an annuity that pays $100 for the next 3 years with the discount rate of 10% today has a present value of $248.69. What's very clear when we look at this example is that the sum of these cash flows is different from these individual cash flows. So if we're comparing an annuity that's going to pay you $100 for the next 3 years, you can see it has a much higher present value than a one-time cash flow of $100 that you're expected to get at the end of a 3rd year. Said differently, 75.13, the present value of that one cash flow, is considerably smaller than the present value of the annuity, which are all 3 cash flows. So because everything is the same, we don't have to discount the individual cash flows. We can throw it into our annuity formula and look, we get the exact same answer. So step by step, what do we have? C is our cash flow. In this example, it was 100. R is our discount rate. Our discount rate was given to us. It was 10%. And N is the number of time periods for our annuity. In this example, it was 3, because at the end of each year for 3 years, you're going to pay me $100 again starting next year. So what's beautiful is when we throw it into our formula, we just calculate it away and we get the exact same answer, and we didn't have to worry about individual cash flows. So it kind of helps us to reduce some of the error that sometimes can happen when we're trying to calculate this out. What exactly are examples of annuities? So an example of an annuity is a finite life project. Basically, if you have a project that's going to give you cash for the next 5 years, or for the next 7 years, or the next 10 years, if it's a fixed stream of revenue, meaning it's going to be the same amount of money coming in, then it's an annuity. A great example of an annuity is a 30-year mortgage or a 5-year car loan. You know exactly how much you're going to be paying to the bank or to the lender or to the creditor on a specific monthly schedule for a specific amount of years. So those are examples of annuities. A perpetuity, you can think of a great example for perpetuity as long-term debt that the company just continually rolls over. So that may not feel very intuitive now, but I promise you when we get into capital structure, you'll remember it. Another example of a perpetuity is stock. Stocks are never ending, meaning if I own a share of a company, my share doesn't have an expiration date. So we tend to think of valuing a stock as a never ending stream of dividends, as a perpetual stream of dividends. And the same thing with real estate valuation. I know from valuing REITs and from valuing other companies that are essentially REITs, that it's the same exact idea. You basically have a perpetual stream of dividend and rental income that you want to price out using a perpetuity. Okay, so let's do some examples. So for these examples, you have the information provided to you on Blackboard. You have the answers provided to you on Blackboard. But before you look at the answers, what I want you to do is to get a pen and paper, or get a piece of paper, or open up Excel and actually try to do these on your own. I want you to try these examples, work through them, see where you're getting tripped up, or see how you're setting it up, and see what you're not setting up correctly, and then take a look at the answer. And don't worry, we will have plenty of time to address whatever is giving us difficulty as we try to go through these problems. So let's do our examples. Example 1 for annuities. Your new 30-year 5% APR, annual percentage rate mortgage, requires a payment of $40K per year starting next year. How much does your house cost? So in this example, I know what my C is. I know my C is going to be 40K, 40,000. I also know my discount rate. I know my R is 5%, and I know my N. I know that it's going to be 30. So I'm just going to throw this right into my annuity formula, and then I'll find an answer. What would be the value of this house, part B? What would be the value of this house today if you had to start making payments in exactly 5 years? So here, what I would like you to do is to draw a timeline for 2 reasons. First, you've already calculated the value of the house. So let's kind of just put a pin in that. We'll call that house value. Now what we're trying to figure out is what would be the present value of the house if we had to make payments in exactly 5 years. So 2 things. First, when you calculated the present value of the house and applied the annuity formula, it's as if the payments start next year. If I want to calculate the value of the house, if I had to make payments in exactly 5 years, I'm actually not going to take that annuity and discount it by 1 plus R to the power of 5. I'm going to take that annuity and discount it by 1 plus R to the power of 4. Why? because it already calculates the present value as if the payments start next period. So this is something that sometimes can trip us up, especially when we're thinking about discounting and all of it. So just be careful of that. Part C, you want to pay off your $1 million home. You did really well. I'm proud of you. You want to pay off your $1 million home over 20 years, starting next year using a 6% APR mortgage. How much do you have to pay per year? So in this example, what are we doing? Well, we're flipping our annuity formula. We know our 1 million, which is the loan that we got today. That's the present value. We also know our R, our discount rate. Our APR is 6%. And lastly, we know our time period, our N. We know it's going to be 20 periods, 20 payments. The only thing we don't know is C. We don't know on an annual basis how much cash are we going to have to pay in order to finance this mortgage. So that's what we're solving for. We're solving for C. So you'll see how to set it up. But again, just be very mindful of your order of operations. So you always want to handle what's in your parentheses first, and then your exponents. So just do it step by step to see what you find and see what's giving you any difficulty as you solve these examples. Let's do an example of a perpetuity. Your family has a perpetual trust fund that pays $100K per month starting next month. The fund is in an account that offers 1% interest per month. How much is the fund worth today? So what do we have? We've got in our numerator 100,000. And what do we have in our denominator? Hopefully, in our denominator, we've got what? We've got R, right? Because that's our perpetuity formula, C divided by R. Part B, suppose instead that the fund begins paying 100K per month in 13 months. How much is the fund worth today? Again, same intuition. Your perpetuity formula tells you the present value of these cash flows if they were to start next month. So if I want to figure out the value of this, if I have to wait 13 months, instead of dividing the present value of that perpetuity by 1 plus R to the power of 13, I'm going to divide it by 1 plus R to the power of 12. Why? Because the numerator already accounts for these cash flows being 1 month away. So in these examples, if I did it to the power of 13, I would be essentially double counting that time period. So again, it's just a little thing that sometimes can trip us up if it's been a while since we've had to look at discounting and cash flows. Okay, another example of perpetuity. You've taken out a 500K loan. You will never pay back any principal on this loan, but you'll always make the interest payment of 8% per year. So step by step, you owe 500K, you're gonna just make interest payments, and that's all you'll do. Suppose you get a tax credit of 40% for your interest payments. That is, the government gives you back 40% of the interest that you pay out every year. What is the present value of all your tax credits? Assume your discount rate is the same as the cost of debt, which was 8%. So step by step, I've got my 500K. I know that every year I'm going to make interest payments. The interest is 8% per year. So every year I pay 40K. Every year that I do pay 40K, I also get a 40% tax credit. So I take my 40K and I multiply it by 0.4. So now with that 16K, what am I doing? Well, that 16K, that is the value of the tax credit that I receive from the government. And I know that I'm going to receive that tax credit every single year forever. Why? Because we said that I have this loan that I'm holding perpetually, and all I'm doing is paying the interest on it. Okay, so how do I calculate the present value of that tax credit? I'm going to take that 16K and I'm going to divide it by my discount rate, the 0.08. So when you do the math, hopefully you'll find that it equals to 200,000. So before we move on, this is kind of an important point to note. The 40,000 that you spend in taxes, the 40% of that 40,000, the 16K, the reason why that 16K has a much larger present value of 200,000, it's because you're going to be doing this forever. So it's the perpetual value that you've calculated. Okay, growing annuities and growing perpetuities. What we'll do is we'll go through an example of a growing annuity, and then we'll go through an example of a growing perpetuity, and then we'll take a break and we'll return with an example of amortization. So a growing annuity, it's a stream of cash flows over a finite time period that grows at a constant rate G. What does that mean? It means that we already talked about our discount rate. So discount rate we've got, but our cash flows can also grow. They can grow by some specific rate. If they're growing at a constant rate across these time periods, then we're going to apply our growing annuity formula. Notice that in the annuity formula, in the growing annuity formula, there are two things that are different. First, we have R minus G. So R is our discount rate and G is our growth rate. If we've got a discount rate of 10% and a growth rate of 2%, we're going to be dividing this thing by 8%. What's the intuition? Well, if it's growing and this number is getting bigger, then the denominator itself is getting smaller and smaller and smaller. So why do we care? Well, if I divide a number by 10 versus dividing it by 5, if I divide it by 5, I'm going to get a much bigger number. Why is that important? As your cash flows grow, the present value is going to increase. And it's the same here when we look inside the annuity factor. We've got 1 minus 1 plus G divided by 1 plus R. So previously, when we looked at ordinary annuities that weren't growing, it's because the G was always 0. So it was always there, but it was just 0. Okay, growing perpetuity, same idea. You've got a perpetual stream of cash flows. We know our discount rate R, C divided by R, tells us the present value of the growing of a perpetuity, but now those cash flows are going to grow. We've got C divided by R minus G, same intuition. If I'm dividing by 10, I'm going to get a much smaller number than if I'm dividing by 2. So the larger the growth rate for these cash flows, the higher the present value. The smaller you shrink that denominator, and the way you shrink it is with a larger growth rate, R minus G, G gets bigger, denominator gets smaller, the whole fraction gets larger. So this is the intuition. Let's do some examples. A growing annuity. Your firm is considering a project that provides cash flows for 30 years. The cash flow in the first year is estimated to be 10 million, and cash flows are expected to grow by 5% per year for the life of the project. Suppose the project's cost of capital is 12%. What is the value of expected net cash flows generated by this project? So step by step, I know how much it's going to come in, 10 million per year. I know it's going to run for the next 30 years. Okay, great. I even know my discount rate. We said that my discount rate, my project's cost of capital is 12%. What's new is that we also now have a growth rate. It's going to grow by 5% per year for the life of the project. So what do you observe? Hopefully you observe that as you plug the numbers in, you have, you can solve it. You can solve it straight away. So let's do another example. Okay. You plan to hold a stock in perpetuity. You expect the first dividend of $2.50 to be paid next year and expect the dividend payment every year thereafter to grow by 4% per year. Your expected rate of return for the stock is 10%. What are you willing to pay for this stock today? So this is why we think of sometimes as the stock price as the discounted perpetual dividend, as a stream of perpetual dividends. So we've got our 250, we divided by 0.10, our discount rate, minus 0.04, our growth rate. Two things to jump out to you. First, you can see how relatively small changes in that growth rate is going to have a really big effect on the present value. If that's not clear to you, what I want you to do as a numerical exercise is I want you to divide 250 by 0.10 minus 0.05 and then minus 0.03. And you'll see very large differences for a relatively small change in the growth rate. So this is why we think of the dividends as kind of signaling quite a bit to the market. To put this in different perspective, if I told you that a company was going to lower its dividend, you'll observe that the stock price is going to fall, but it's going to fall by a lot more than just that dividend. Why? Well, for a number of reasons. One of them is this process here. As an investor, you're going to take that growth rate and scale it down if you expect the company to have a smaller dividend. The second thing that I hope is clear is that 250, that $2.50 has a pretty large value. Why? Because it's perpetual. So whenever you have something perpetual, even that small number can become quite large. Okay, we're going to take a pause here, and when we return, we're going to go through discount rates, and then we're going to do amortization, basically paying off a loan bit by bit.